Welcome back to Islamic Finance Unboxed, the channel where I try to outline main controversial topics in Islamic finance. Today, we're diving into a topic that impacts nearly every household in the world, insurance. But not just any insurance, we're talking about Takaful, the Islamic alternative designed around cooperation, mutual responsibility, and Shariah compliance. Is Takaful just a halal copy of regular insurance? Why do some scholars object to conventional insurance? And how is Takaful gaining traction in the global market? Let's unpack it all. What is Takaful? The word Takaful comes from the Arabic root kafala, meaning guaranteeing each other. At its core, Takaful is a cooperative system where participants mutually contribute to a fund that is used to support members in times of need, like in the case of death, accident, or loss. Think of it as a community fund based on trust and solidarity. Unlike conventional insurance where you pay premiums to a company aiming to generate profit, Takaful is designed as a risk-sharing model, not risk transfer. It might be called as in case of fund. Why is conventional insurance not Islamic? Conventional insurance is problematic in Islamic jurisprudence for three key reasons. 1. Gharar, excessive uncertainty. You don't know whether you'll benefit from your payment or not. It's a gamble. Maybe you'll never make a claim. 2. Riba, interest. Insurance companies often invest premiums in interest-bearing instruments, which is strictly prohibited in Islam. 3. Maisar, gambling. Some scholars argue that the concept of paying for something uncertain, like future compensation, resembles gambling. This is why Takaful was developed, not just as an ethical or charitable system, but as a Shariah-compliant financial model that avoids these risks. How does Takaful work in practice? Let's break it down step by step. 1. Participants contribute to a shared fund, sometimes called the Takaful fund. 2. Each payment is considered a donation to borrow, not a premium. 3. The fund is managed by a Takaful point either on a wakala agency or Madaraba profit-sharing basis. 4. When a participant faces a medical emergency or car accident, the fund pays out to cover the loss. 5. Any surplus after all claims and operating costs may be redistributed to participants or reinvested for further growth, as long as it stays within Islamic guidelines. This setup makes Takaful a collective guarantee, grounded in ethics, transparency, and shared responsibility. Global growth of Takaful. Takaful isn't just a niche market anymore. It's become a multi-billion-dollar industry growing at double-digit rates in many regions. Key highlights. Malaysia is one of the global leaders, with a fully developed Takaful ecosystem. Gulf countries like Saudi Arabia, UAE, and Qatar have large and expanding Takaful sectors. Indonesia and Pakistan are making regulatory and institutional advances. Even non-Muslim majority countries like the UK and South Africa have started offering Takaful services. Big global insurers like Prudential, Allianz, and HSBC Amana now operate or invest in Takaful businesses. While Takaful and conventional insurance both aim to protect against risks like accidents or health issues, they operate on entirely different principles. Traditional insurance is profit-driven. Your premiums go to a company that manages risk for its own financial gain. Takaful, on the other hand, is rooted in mutual support. Participants pool their contributions to help each other in times of need. It's not a business transaction, but a community-based safety net. The funds are managed ethically and invested only in Shariah-compliant ways, avoiding interest and speculation. So ultimately, Takaful isn't just about individual protection, it's about collective responsibility and shared values. How Takaful works. Car insurance example. Let's say you join a Takaful plan for your car. Every month, you and other drivers contribute a small amount into a shared pool. This pool is managed by a Takaful operator who follows Islamic principles and doesn't aim to make a profit from your risk. Imagine, your car gets into an accident. You file a claim, and after it's verified, the cost of repair is paid from the shared pool. You're not taking money from a company, you're receiving help from the community fund that you and others have supported. And if nobody has major claims that year, any leftover funds may either be saved for the future or shared back with participants as a surplus, depending on the rules of the plan. How Takaful works. Disaster or property insurance. Now think of Takaful for protecting your home or business from disasters like floods, earthquakes, or fires. You contribute regularly to a Takaful disaster protection fund, along with others in the program. If a disaster damages your property, your claim is reviewed. If it meets the criteria, the cost of repair or loss compensation comes from the collective pool. Again, it's not about profit. It's about sharing the burden, just like how a community helps one another after a crisis. The beauty of Takaful is this. Whether it's your car or your home, you're not just buying protection, you're joining a circle of mutual care, built on trust and shared responsibility. It looks like a sophisticated charity fund, isn't it? Earnings, profits, and participant benefits. How do you earn from Takaful, or at least benefit fairly? Surplus distribution. If there are no major claims, the remaining funds may be redistributed to the participants. No interest exposure. Investments are made in halal portfolios, which reduces religious risk. Operator fees. Takaful companies charge management fees, but these are often more transparent and capped compared to conventional firms. And remember, you're not buying a product, you're joining a cooperative system with built-in ethical principles. Takaful and the global economic system. Let's zoom out and look at Takaful in today's global economic frame. In modern world, the trust in conventional financial systems is declining, especially after repeated financial crises, debt bubbles, and profit-driven collapses. More and more people are seeking ethical alternatives, community-driven tools, faith-based transparency. That's where Takaful fits in beautifully. It aligns with ESG principles, environmental, social, governance, social responsibility, and a risk-sharing approach, values that major financial institutions now promote globally. Governments, NGOs, and even global banks like HSBC and Standard Chartered have started tapping into Takaful's potential, not just for Muslim consumers, but for anyone who seeks ethical, inclusive, and sustainable risk management. Takaful is more than just a halal insurance model. It's a powerful financial tool rooted in community, ethics, and cooperation. As Islamic finance continues to evolve, Takaful stands as one of its most practical, human-centered pillars, ready to meet the challenges of modern risk without compromising religious or moral values. If you found this video insightful, don't forget to like, comment, and subscribe. In this channel, we will think together and we will get broadened horizon to cover modernity and real and accurate logic of Islamic finance instruments. It is not totally outdated and traditional meaningless religious rules. Many suggested tool touches to modern expectations in terms of humanity, community-driven development, and participation notions. Accountability and inclusiveness are another critical dimensions of societal development tasks. Stay tuned for more deep dives on Islamic finance, right here on Islamic Finance Unboxed. In the next video, we will dive into the Musaraka with very compact manner. Stay in loop.